This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to episode 25 of Value Investing. Over the last 4 episodes, I talked about a guy named Joel Greenblatt. He was the founder of New York-based hedge fund called Gotham Capital. And the reason why I got so interested in him is because his stock performance was so outstanding. He achieved an annualized rate of return of 40% over the course of 20-year time period when he was managing other people's money. He has written multiple books, but the one that I liked the most was called You Can Be a Stock Market Genius. And I've talked about this book over the last 4 episodes, and if you haven't listened to my last 4 episodes, I highly recommend you go back and listen to them so that you understand the context. And especially over the last 2 episodes, we talked about spinoff situations and why spinoff stocks are good for value investors and why you can find a lot of undervalued opportunities, and undervalued opportunities are built into the system. And in the last episode, I talked about how to identify good spinoff opportunities via Marriott Corporation spinoff example in the past. What I'm going to do in this episode is I'm going to talk about one more example of spinoff and provide 4 tips that you can use when you're trying to identify spinoff opportunity. Before I get started, let me just give you a disclaimer that this podcast is for entertainment purpose only, and it is your responsibility to consult with your investment professional for any investment decisions. Without further ado, why don't we get started? The spin-off company that I'd like to talk about today is called Strattec Security. So let me just provide a bit of background so that you understand the context of this spin-off opportunity. In May of 1994, Briggs, a manufacturer of small power engines, announced its intention to spin off its automotive lock division. The spin-off was scheduled to happen in late 1994 or early 1995. Back then, Briggs, the parent company, was part of S&P 500 with a market cap of $1 billion. And the spin-off company, small division of the parent company called Strattec Security, represented less than 10% of parent company's sales and earnings. So this was a perfect example of high institutional investors selling if the spin-off shares were distributed to parent company shareholders, since the spin-off company with a market cap of approximately $100 million is not appropriate for most institutional investors who manage billions of dollars for their portfolio. On top of that, I want to point out one more thing here, because there is a big segment of market which is driven by passive investors. So these passive investors invest their money in S&P 500 in many cases, and when the spin-off companies are distributed to parent companies' shareholders, and since they are passively investing their money in S&P 500, by definition, they're going to sell the securities regardless of investment merit. So it's a really great opportunity for value investors who have common sense and know the investment merit of the new spin-off company. So here's the first tip that Joel Greenblatt is trying to provide to his readers. Check if spin-off is small in size for institutional investors. And what's more important is that if spin-off happens from a company that belongs to S&P 500, you may have better opportunity because of the selling pressures coming from all different types of investors, including institutional investors and index fund investors. Okay, that was tip number 1. Let's move on to the next segment where we talk about how you can find spin-off opportunities. You can find spin-off opportunities by reading newspapers such as Wall Street Journal or Financial Times. Or you can go to a website that summarizes all recent spin-off events. There are a bunch of websites like that you can easily Google. If you want to dig a little bit deeper, then you can take a look at SEC document called Form 10. A Form 10 is filed in cases where the spin-off represents a small piece of the parent company, and these small spin-offs do not require a shareholder vote. If the spin-off is large, a proxy document is prepared and shareholders get a chance to vote. Let's take a look at the case of Strattec Security. The spin-off announcement happened in May 1984. Form 10 became available to the public in January 1995. An actual spin-off happened at the end of February 1995. So you had 2 months to review this Form 10 document from SEC. As in the case of Marriott spin-off that we discussed in the last episode, Joel Greenblatt's first move was to check out what insiders are up to. Under the heading Reasons for the Distribution in the Form 10 document, the board of directors revealed the primary reason for the spin-off. The board said that the spin-off happens to provide incentive compensation to key employees that is equity-based and tied to the value of Strattec business operation. The performance and compensation would be more directly aligned as a separate public company than as an indistinguishable unit of Briggs, which was the parent company. According to the section Stock Incentive Plan in Form 10, the spin-off company plans to reserve over 12% of new company's shares to provide incentives for employees and management team. Joel Greenblatt said that in the book, he loved this generosity of stock options and restricted stock plans. This is where Joel Greenblatt has differing view compared to Warren Buffett, because Warren Buffett is not a big fan of stock options, which do not have downside risk once given to management team. However, Joel Greenblatt thinks that the management team should be incentivized to act like owners, and the best way to do that is through stock-based compensations. So here's tip number 2. Check insider ownership data whenever there's a spin-off event. So let's move on to the next segment. So in addition to the ownership info, you have to pay attention to the summary section of Form 10. The summary section is about 5 to 8 pages long usually and contains a summary of the next hundreds of pages in Form 10. It gives you good idea in terms of where to put your focus. One area you should pay special attention to is pro forma statements. The pro forma statements show what the balance sheet and income statement would have looked like if the new entity had existed as an independent company in prior years. So it gives a lot of financial information, so you have to take a look at it before you make an investment decision. Based on pro forma financial statements, the spin-off company, Strattec, had earnings per share $1.18, and that was 10% increase from prior year. Joel Greenblatt looked at industry average P ratio for auto part companies, and it was about 10. And he also looked at the range of auto part industry, P ratio range of auto part industry, and it was about 9 to 13. So if you apply P ratio of 9, you're going to get to intrinsic value of $10.62. And if you apply P ratio of 13, then you'd get $15.34. So this is kind of the intrinsic value range that Joel Greenblatt derived from pro forma statements. And this is very preliminary stage to assess intrinsic value. Joel Greenblatt thought that unless Strattec spinoff company started trading at $6 to $7 per share, which is significant discount from his intrinsic value calculation, unless that happens, he wasn't going to be interested in the stock. So here's tip number 3. Check pro forma statement and derive the intrinsic value in a conservative manner. So let's move on to the next segment. Supplying parts to auto manufacturers is generally considered a very crappy business. So Joel Greenblatt wanted to know more about the business to see if he can find anything interesting. And he did. Under the section called Business of the Company, Strattec was by far the largest supplier of locks to General Motors, which was about 50% of Strattec's revenue, and also provided almost all of Chrysler's locks, which was about 16% of Strattec's revenue. From this, Joel Greenblatt thought that Strattec must be pretty good at making car locks. However, the next piece of information was a lot more exciting. According to the filing, the management believed that Ford will become its second largest customer in the next year. And this one piece of information didn't really have any special banner headlines in Form 10, but was the most important piece of information out of hundreds of pages of the document. All the numbers in pro forma statement I just mentioned didn't include any Ford business, which expects to order more locks than Chrysler business that accounts for 16% of revenue currently. So here's tip number 4. Look for hidden information that could dramatically change the intrinsic value and use your common sense to assess that hidden information. And if you think about investment process, there are hundreds of pages of documents when you go to SEC website and when you look at a bunch of other documents. I think the main thing that you have to be concerned about is not about reading all these hundreds of pages. You have to know how to selectively collect critical information and screen out all non-relevant information, because there are just so many information in the document, and it's not always better to have more information, but you always have to look for most critical information out of hundreds of pages of document. Okay, now you might be curious about what actually happened after the spinoff. For several months after the spinoff, the stock traded at P ratio of 9 to 10, which was about $10 to $12 stock price. The P ratio seemed to indicate that the market did not take into account 3 positive things that we have discussed in today's episode. First, the P ratio didn't take into account upcoming contract with Ford, which is expected to be the second largest client for the company. And second, the P ratio didn't take into account Strattec's dominant position in the market with 3 largest automakers, Ford, General Motors, Chrysler. And lastly, the P ratio didn't take into account the recent 10% growth in earning per share that was illustrated in Form 10. Having said that, Joel Greenblatt thought that this is a really good buy for value investors like him, and he purchased shares of the spinoff, and stock moved up to $18 within 8 months of the spinoff. So this is a wonderful example that provides a lot of tips on how to buy good spinoff stocks. So in this episode, we talked about 4 tips. So let me just quickly recap what we have discussed. When you see spinoff company, the first thing you can check is whether the spinoff is small in size for institutional investors. The rule of thumb is less than $1 billion. And what's going to be even better is that if spinoff happens from parent company that belongs to S&P 500, you're going to see a lot more selling pressure, not only from institutional investors, but also from ETF passive investors. Because if you think carefully, they are selling all these spin-off companies' stocks distributed to them without thinking about investment merit. If they really have common sense and rational mind and sell these distributed shares purely based on investment merit, then you may not have a good chance of finding undervalued opportunities. But that's not the case here for spin-off companies. That was tip number 1. Check if the spin-off is small in size for institutional investors. Okay, tip number 2, check insider ownership data. And this is the point that Joel Greenblatt has discussed many times throughout his book. And I think this is quite important information. And what's even better is that it is easy to find insider ownership data, whichever document that you look at. You can, for example, look at Form 10, or if you are interested in just buying stocks in the public market, you can go to websites such as gurufocus.com in order to find insider information easily. So why don't you take advantage of the information easily available? And as I mentioned, it is important to identify which one is critical information and which one is not. And obviously, insider information is crucial one to see if the company is going to be successful in the future. Let's move on to tip 3. Tip 3 is check pro forma statement and derive the intrinsic value in a conservative manner. Joel Greenblatt used simple PE ratio to derive intrinsic value of the spin-off company, and he used the industry range to see how auto manufacturers' P ratio is currently in the market. So P ratio was about 9 to 13, and he used this range, P ratio range, in order to derive intrinsic value range for the spin-off company. Tip 4. Look for hidden information that could dramatically change the intrinsic value and use your common sense. In the case of Strattec's example, Joel Greenblatt found out that Ford is expected to become the second largest client for the spin-off company. And that information, that piece of information was not incorporated into pro forma earning per share. And that got Joel Greenblatt excited. And that's why Joel Greenblatt purchased shares of spin-off company, and this investment became super successful for him. So those are the 4 tips that Joel Greenblatt mentioned through Strattec Security spin-off example. Okay, that's it for today's show. I hope you enjoyed listening to this episode and learned useful investment tips. In today's show note, I'll include an Amazon link for the book You Can Be a Stock Market Genius by Joel Greenblatt that we discussed in today's episode, in case you're interested in buying the book. Also, I'm starting to take donations now, so if you want to show your appreciation for the show, you can do so via the donation link in the show note. Lastly, 5-star review always goes a long way, whichever platform you listen to this podcast. Thank you very much and see you next time.